Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, October 15th, 2021. The S&P 500 is currently sitting at 4463. I'm Scott Steiner. I'm here with Buff Bagwell, and we're going to walk through markets today. I don't know what you feel about that. I just gave myself my own nickname. I've been waiting 80 plus episodes for my own, and so I'm the turd that gives himself his own nickname.
I think that's totally fair. I mean, that's a classic tag team combo, right?
Yeah. That's what it's a new world order, and we just want to represent that a little bit.
But are we the bad guys now?
I don't know. Are we the bad guys if we communicate that price is refuting the narrative of the day? Probably. Maybe.
Yeah. I mean, that's what NWO did every time they got into the ring.
They brought up some charts.
Yeah.
I love it. That's
charts,
right.
Hey, stocks having a pretty good week.
Yeah, not bad.
So far this week, especially the last 2 days.
Yes. And reclaiming some important levels on a couple different indexes, seeing a little broadening out of areas that are showing strength. We've harped on small caps for how long, and we'll continue to until they're above 234 using something like IWM. But it's good to see it above 222. It's at least a start.
It is. So we got up to 228 right now, above 226. So we'll see. I mean,
and we're above.
We've talked about, there's so much, there's so much price history to the left that it seems every 50-cent move in either direction on IWM is some type of previous resistance or support. So it's a weird one to navigate. But yeah, 222, kind of that top half. If you're above there, you're in the top half of this range we've been in. So
it's a good start.
Better than being in the bottom half.
Yep. And to paint the picture for clients who might not look at charts every day, what Ian is talking about is that we are still below a price level that has had significance in the past. So when he says look left, what he's doing is he's looking left on a chart. He's looking into the past on a chart and noticing that supply overtook demand back in March in small caps. It did it again in April, June, end of June, and beginning of July. And we are now coming back up and hopefully potentially testing those levels again to see if there's sellers still there. And so we'll find out. This
is kind of a great argument of why so many people involved in technical analysis like to buy things when they're breaking to new all-time highs. As counterintuitive as it sounds, again, from a technician standpoint, you're buying all-time highs. There's nothing to the left to worry about. There's no, we're coming up on resistance, from 6 months ago.
You're not carrying market baggage.
No.
Right? Like, so we as human beings, we walk through life and we do, whether we like it or not, we carry baggage from our past. That's that resistance that you're talking about. For example, you buy IWM at 234 back in March, and you've been underwater the whole time since then. And now you get back to 234. Oh, thank goodness I got my money back. What are you doing? You're selling. And we do the same thing in our relationships, in life. We mirror behavior in the present time based on things that have happened in our past. So it's a natural thing. So what Ian's talking about, though, is that when you get above those levels, you no longer have the baggage. You've moved past that resistance.
There's nothing to worry about. Blue skies are a really good feeling.
Yeah. And that what is wrong with overwhelming demand for a stock that takes it
so much demand that people are willing to pay the most they've ever paid for a share of that stock.
Right.
And so many people will tell you that sounds idiotic. Why would I not want to get a deal?
Right. It's at an all-time high, and that's too much, right? It's
Like how do you think the chart goes from
lower left to upper right.
upper right? Like how do we think that happens? It's got to make new highs. Yeah, maybe you buy like you can get a quote unquote better price if you buy a dip and it's before someone like us who would wait for new highs. But from a risk return perspective, I know that I'm wrong a lot quicker.
Oh, for sure. And I had a conversation with a prospect, now client, this week, who confessed, yeah, I bought the dip in crypto and it just kept dipping another 20%. So they held on through the whole, the big, 50% drawdown for them in that period. So that's hard to sit through. That's not meant for everybody. That's why we use the adaptive system, because we don't have to blindly buy dips.
Not for me.
Yeah, it's not. We don't have to. That. Yeah, we don't have to blindly buy dips. There's nothing wrong with a sequence of higher highs and higher lows on a price chart going from lower left to upper right. That means we have an uptrend on our hands. That means we've got overwhelming demand. We got demand outpacing supply. That's an economic law. That's not a theory. That's not a guess. That's not an opinion. That's just a fact.
Well, and how many people, right? So, we spent some time this week kind of bashing the large telecom stocks, AT&T, Verizon, T-Mobile. I mean, they just look
brutal,
horrible. Yep. I mean, the long-term charts are, this could end up turning into like an avoid telecom for multiple years type of situation.
Well, I guess to that point, it really has been, right? We've been in a series of lower highs and lower lows versus the S&P 500 on something like AT&T going back to August of 1994. And so I'm not contradicting you. It just seems to be accelerating. Like, do not own telecom.
Yeah. Again, and I don't know. Like, I don't know what that means, right? There'll be a story. Yeah. There will be a story one day that explains this. It could be tomorrow. It could be 2024 when AT&T is trading at $10. But so many people want to go out and buy these particular names. And I had so many comments about this on Twitter. Buying the dips in these, right? And a big deal was because, well, look how big the dividend yield.
I was just gonna say that. Oh my God. The dividend. But the dividend
yielding 8%. It's gotta be. It's a blue chip. It's gotta be great. I mean, if cash flow is absolutely your one and only goal, then sure.
Hey, congratulations on your dividend today. The stock's down 7%.
Yeah.
I don't know. And in the past,
now you've given up that cash flow. Congrats.
Yeah. And now since May, you're down 25% because you just love that dividend. So there are times where, yes, if you're looking for just an income producing model and you're just going to hold through everything, and you understand that there are stocks that go to zero that did pay a dividend, and we can name quite a few if we want to go look back in 08, 09. We can even go look back at the early 2000s and see all the dividends that evaporated and companies that went to zero.
Well, and then how many, right? Choice. How juicy did those, 2015, 2016 during as equity was, bumbling around and selling off, and those dividends were getting bigger and bigger, and then the dividends got cut. Right. So
you just have to be aware of both. Love
so dividends. Now you're great. Now you're down 50%, and your cash flow just got cut by a third.
Right.
Oops.
Right. And we're not completely hating on dividend payers.
No, I am a big fan. I am a fan of,
but blindly holding because of dividend
investing.
But blindly holding for dividends also is not appropriate.
Yeah.
So, and your point is spot on. The telecom names that are just under tremendous pressure right now and just abhorrent to look at on a relative basis.
Yeah, why bother with it?
Yeah. Yeah. Why mess around? Why do we need to play with knives? Why do we have to try to catch a falling knife? Let these things play out, man. Like, you don't have to get involved right now. There's nothing saying that you're forced into having to make that trade. And why not? Why not? So markets are hard enough the way they are, right? So it's the most competitive arena on the planet. So why not maybe put some odds in your favor? And what I mean by that is markets have a tendency to trend. That's a fact. That is a factor-based investment scenario that takes place over and over. You see things either move from lower left to upper right, or they're moving from upper left to lower right. They trend. Mm-hmm. Why try to own something in a downtrend? Now, it's intuitively obvious to the technician, right? Because that's what we do. We just study supply and demand. We see these things on charts. Mm-hmm. Whereas others might just be looking at balance sheets and dividends, and charts are the secret sauce. So I'm going to say, like, I'm not the smartest person in the room. Charts are my equalizer. It's the manifestation of opinion, final arbiter of value. So that's why we use them. So we're on our New World Order soapbox a little bit there, kind of along the lines of dividends. I'm going to pivot a little bit, but value versus growth, rates. What are we seeing?
Rates. I've stalled out a little bit here, bouncing today. So, I mean, it was really, got up to, what was it, 2.18. So kind of a previous area that we saw back in April, May as support broke that. We'll see if it continues to act as resistance, but, should rates continue lower, probably will have a ripple effect, probably going to want to, get back to looking at those growthier areas of the market, but no really quote unquote breakdown yet there on a relative basis from value. I mean, it's energy and financials continue to hold strong. Apple's still not above 145. So I don't want to sound too simplistic, but I don't know what growth does or large and mega cap growth or the NASDAQ does with Apple below its January highs.
Right.
Like, you're not going anywhere with Apple without Apple leading. It just is what it is.
From a broad indices perspective.
Yeah, from a broad indices, just because of their weighting. You need FANGs to participate.
And some of them have come back, but your point is valid on Apple. And I would add with the rates, this week's move doesn't really negate what potentially is a move towards, let's use 30-year yield and talk about 2.4.
I was going to say 2.4, 2.5.
Right. And as long as we're in that instrument above 1.97, 96, I mean, this week is more of like counter trend. So we'll see.
Sure.
We'll see.
I would say a potential right shoulder. I mean, if you get above 2.5, now I don't think that's going to happen this calendar year. That would be that would be a pretty remarkable run into the end of the year for rates. I think you could definitely see it in Q1.
For say it again, for rates
to get back,
where?
to get back to that 2.5 area.
Oh, see, I think
you think it could happen this year?
How long was this period of time?
I mean, I guess if you kept the same rate of trend, you would get there early December.
February through August. So we've got, 6 months there. Yeah, you're probably right. We're probably looking at a 2022.
But you get through 2.5 on the 30-year. I mean, zoom out. It's a major behavioral level.
Oh, huge.
Going back to, I mean, that was huge. The bottom. That was the 08 bottom. You get back above there. I mean, that's a lot of evidence that we are going to enter a long-term rising rates scenario.
Yep. And that's something we've harped on in the past, and it's just really interesting because we know inflation is a narrative, and yet this week, in the the short attention span of some media outlets, you have some already saying like, "Oh, I remember when inflation meant higher rates," and they're saying that only because we've had a 1 week reprieve in what rates have done. one day, 1 week doesn't make a trend, right? Like last week, I believe I said that the Tampa Bay Rays looked like they were going to, based on one game, and they subsequently, it wasn't a trend. They subsequently lost 3 straight, and they're sitting at home now. And so same thing, just because rates have a 1 week reprieve doesn't mean the potential of higher rates has been eliminated.
I don't necessarily think the underlying stocks, I would say, I mean, bank stocks don't seem to be really believing in the rate. I mean, this little 3-day correction we had.
Yeah, they're potentially going out at new closing weekly highs all time for something like BKX, a big bank index like that.
Financials still looking good. And it's not just banks. You've got insurance, asset managers, capital markets.
Yeah, everything financials, right?
I mean, financials as a whole, banks are going to get the most TV time, of course. And they just, it's banks earnings season. We just had Bank of America and JP Morgan. Think they had good earnings. I'm not sure. The reactions were good. That's kind of all that matters.
Yeah, it's not the earnings, it's the reaction to the earnings that matter.
And yeah, so like I said, they're going to get the most of the attention, right? No one wants to talk about, casualty insurance or, the ICE exchange or boring, Jeffries, Apollo Global, but these are working just as well as the household big banks and European banks looking good. So,
but Ian, uptrends are boring.
They are. I mean, I like making money. So it's not that boring.
No, I'm with you. I just, why fight the trend? Related to that, you did a good job breaking down what's going on with financials. Base metals.
Yeah.
Baseball metals. Base metals.
All of aluminum,
tin,
nickel.
Yeah, you name it. Even copper. I think one of the more important and substantial price movements this week has been out of copper. And there's a reason why it's called Dr. Copper, right? It's an economically sensitive metal. It's something that's used in a lot of different building, electrical, mechanical technology. Anything you can name that's being created typically has some component of copper in it. And so that breaking out of this consolidation that's gone on for, if I use copper futures as an example, something that's been going on basically since May of this year, to break out of that it's a great development. Even copper stocks.
It was a well-behaved,
right? Perfectly normal consolidation.
Right into a 200. I mean,
yeah,
there's not much better textbook bear flag, bear pennant, whatever you want to call this, sideways consolidation, beautiful, safe landing, multiple touches of the 200-day, and now looks to be off to the races. I don't know what's not to like there.
Well, yeah, and I know like the All-Star Charts team, they do a good job highlighting important, risk on, risk off ratios, and one of them is, copper to gold, comparing copper to gold.
New highs today.
Yeah, that is risk on behavior when the demand for copper outpaces the demand for gold.
And it reached overbought on daily RSI. It's
risk on. We're not piling into aluminum, tin, nickel, copper if we've got Armageddon on our hands.
What I find most interesting, right? So we're sitting here, we've seen this, still see strength out of commodities as a whole. I know we talked about base metals, but crude.
Yeah.
Lots of these areas, still lots of these, and some of the grains, coffee is getting hit today, but
not oats. I mean, oats are going to the moon.
We still see that. So what I was going to say is, interestingly enough, I mean, it's not like the dollar's broken down yet.
Correct. The dollar, right. The dollar's still sitting above 94. Dollar trade weighted dollar, DXY, still above 94. Mm-hmm. And it's moved higher in these, and we've seen commodities move higher.
So
let's not overthink this.
Someone's calling someone else's bluff, or
It's
It
just
just is what it is.
and it's that strong.
Yeah.
Like that's if the dollar's holding up or rising and commodities are doing this, how strong are commodities? Like, let's not overcomplicate this. Like, that's tremendous information that all those things that you just listed, all those commodities moving higher with the dollar holding up.
I mean, the dollar is, it's a great point. It being the headwind that it
Could be.
And it in theory should or would be.
I mean, what's to complain about if those are moving higher? I mean, and I know oats aren't sexy to talk about, but they can go to the moon just like any crypto
and
can.
I mean, right? It's another example. These macro playbook theses they're hard because you do find yourself in environments where dollar and commodities are going up.
Mm-hmm.
But that shouldn't be happening according to a lot of textbooks out there.
Right. And it's hard because things go into correlation and things fall out of correlation. And so it's just being aware of this goes back to, and I believe it was last week, we talked about quote unquote should be. This is what should be happening. And what we need to pay attention to is when the should be doesn't happen. Right? If your team should be hitting the ball and is not, that's something to pay attention to. Like, that's information. Same thing. If commodities should be paying the price for a higher dollar, but they're not, that's really important. So, covered base metals, we could jump into cryptos because we had, pretty big development this week as we progress in Bitcoin, which is, the most common. It's the one everybody talks about. I'm still convinced there's parts of our society that when you bring up crypto, they just think Bitcoin. But what are we seeing out of
Bitcoin above 60,000, likely going out at an all-time. Now, you want to call it a weekly, depending on maybe your weekend Sunday night, because cryptos. We're going to use the standard 4:00 close on a Friday, but as of right now, Bitcoin would be going out at an all-time weekly closing high above the, what was that, like early April?
Mm-hmm.
So, I mean,
that's bad though.
Right, it goes, but what do we just talk about now?
That's
I guess
bad. It's
all
a new
time
high.
intra-week high is 63, 64-ish, 65-ish maybe.
Yeah, it's 64,899. Not that anybody's counting, but your point is valid. A new weekly closing high. Now, we're using, like you said, there's lots of debates on that, but that would be significant if we close that way at the end of the weekly candle. Be huge. It's a new high. You don't get to deny that fact that there was that much demand outpacing supply for Bitcoin, and we've seen it across the spectrum.
Does this turn into what we saw in October? I don't have no idea. That'd be awesome. We'll be ready.
And there's plenty more. There's plenty of other cryptos that are performing just fine. And so it is interesting to see that the OG like Bitcoin doing this, but also some of the more, I don't even know if I want to use the term alternative coin.
Speculative.
Yeah. I mean, it's a hard phrase, but if you're in crypto, I think you know what I'm referencing here, that it's not just your
altcoins.
Yeah, it's not your big Bitcoin, Ethereum, Cardano, Litecoin group. It's outside of that. So many different cryptos. And there does seem to be a fair amount of broad-based demand for those. And that's important too. And that's happening also with the dollar holding up. So not only are we seeing it on base metals, commodities in general, and cryptos. That's just a ton of information right there, that risk on behavior. This is risk on behavior. And so do we get to be surprised if heading into the seasonally strongest part of the year, which the weakest part of October is now passing us by. Mid-October is notorious from, September into mid-October has definitely some weak characteristics. As we head into the end of the year, get strong. And so do we get to be surprised if we see new highs in the S&P 500 before the year is over? Absolutely not. Based on all the things we're seeing now.
And do we get to be surprised if, I don't want to be that guy, but right, if we come back down to 219, 220 on IWM?
No, we don't.
I mean, right, because that's been, until that changes, mean, you could argue that would be what to expect here. I'm not saying the position for, I'm not saying go out and fade, small caps here at 227. But I mean, you can stay in trend. You can still keep these higher lows that we've had since late August and come back down a few more times, right? We talked about it last week. This consolidation may not be over till January. It may not be over till 2022.
Right. Your point about characteristic is so spot on. Like we're waiting for that characteristic to change.
Right?
And
that's why we don't buy at resistance.
Right. And so what's interesting too is without looking at the chart right in front of me, my guess is that we are currently above those compressed moving averages that we talked about last week that were within 2% of each other. Is that a correct statement?
Yeah.
That we're now sitting above that. So
yes.
now we tilt things in favor of maybe we do see the characteristic break to the upside. But your point is also valid. Like we're not going to go into this closed-minded and think that it's not possible to break to the downside. It absolutely can. Every day is a new day. We're Bayesian. We take in the data as it comes. Next week, if we're down, or in the next following weeks, we're below 222 again, below 214, below 210. That's a characteristic change too. We'd be back below those moving averages that you did the research on. We'd be outside this range to the downside.
Yeah, and it's gonna take some effort to get these moving averages to start, expanding again. Now, of course, on the short-term ones, yes, they've turned up, but your 100, your 200 day, your 150 moves like we've seen this week aren't gonna do much. But you get back up, like you said, 234. I mean, if you could definitely see these start expanding here in a couple weeks.
Well, the good news is that the 200 day is rising. And then what I mean by that is typically a flat 200 day, and I learned this from JC Pretz, is price moving around, that's just a hot mess. When the 200 day is moving sideways, you typically just see messy price action. Now, we've had messy price action for 8 months, but the good news is we've tagged this rising 200-day moving average a few times now, and it's quote unquote held. I don't necessarily like thinking of it as support, but now we're moving higher out of that. So we'll see. You highlighted last week, like just how much energy is being built up here. We could see a tremendous move to the upside. We're definitely not opposed to that. I know that.
Well, and I wonder, I mean, speaking of 200-day moving averages, copper, going back to what we just talked about, I wonder, I mean, it has so much similar behavior to IWM. When you talk about their approach and this consolidation that they've been in the last few months and how we've kind of coasted into this 200-day.
Yeah. It's got
is it a, are we foreshadowing
is copper foreshadowing the small cap move? Is that a fair question? Is that the question you're asking?
Yes.
Yeah. I think that is a fantastic and valid point, because it both would be tremendously risk on, and it's Dr. Copper, man. So I think that's fair, that copper showing, what would you say, a few days in advance, a week or so in advance, potentially foreshadowing what is to come. Could be. I mean, it's not a zero chance. It's above that for sure. So good stuff there. Before we close down the client portion, anything else you want to touch base on before we jump into the extended portion and cover some things that we're seeing internationally and look at precious metals this time?
No, I think I'm going to save all my special comments for the Lunch and Learn.
Nice. Yes, Lunch and Learn coming up this next Wednesday. It's going to be great to have you back in town. I know the team here is looking forward to it, and should be a great presentation next Wednesday. So awesome. Appreciate it. Everyone listening, we appreciate it. You guys have a great week ahead.
Have a great weekend, everyone.
All right, Ian, jumping into the extended portion of the podcast. I know I teased it a little bit, talking about what we're seeing internationally, what we're seeing out of precious metals, but I wanted to start off with one of our favorite subsectors, semiconductors.
Semiconductors have been disappointing on a relative basis as of late.
Right. We still haven't gotten back
the last
to
month.
Yeah. And we haven't from a relative perspective, if you take ETF like SMH, which represents semiconductors, and you compare it to the S&P 500, we're still well off the February highs. Yet the market has digested that well. So we're about 9 to 10% from a relative perspective off of that. But I think it is notable to see some of the bigger players in that space, like Taiwan Semiconductors, hold really important levels, such as 109-ish on Taiwan Semiconductors, like TSM, even AMD holding, let's call it $100.50 and moving higher out of that. NVIDIA has been strong throughout this, but that held 200. The weak sister, if you will, is Micron. That's the one that kind of makes you sit back and be open to the possibilities of what might be going on with semiconductors. And if semiconductors aren't doing well, how well is the market doing? But if Micron gets back above 69, 70 bucks,
it's a good sign.
It could be game on. Same with Applied Materials, still above 122, 123. That's a positive sign. So those are some of the bigger semiconductor names. So while we've seen weakness since February in that area, we might be starting to see that turn around. And if it did, another feather in the cap of risk on behavior.
For sure. Semiconductors are very important. I guess there's been a lot of news around them this year with supply chain shortages and whatnot. I don't think we need to harp on the fact that that's not really our cup of tea. I think most people are aware of that. But
they make good magazine covers, though.
They do.
Apparently.
But transport's also turning around.
Yes.
And those are not, right? So transports, again, it's about what gets the most airtime. So your FedEx and UPS have been horrible. The railroads that have been rough, popping back up on doubles again. Trucking has been strong. So transport's there, but really, that's the FedEx and UPS are gonna lead the way there. But there have been pockets.
Well, and how should I think about if we've got magazine covers, multiple, not just one, talking about shortages, and I'm getting direct messages about shortages in supply chains and the Great Depression. Chances are media is all over this one and they're correct, right? I don't know. To me, and I know I'm saying that facetious and sarcastic, and there's a reason for that. And I think we're starting to see some things come out in different industries regarding media that I think we all need to sit up and look ourselves in the mirror and ask ourselves, have we been doing our own due diligence, or are we just spoon-fed and we take everything as fact that has been fed to us?
Well, it's easier just to assume it's true and go on about your day, because verifying is extra work.
It is. And work is work.
Because then you got to open the internet tab, you got to Google search, and you got to spend a few minutes reading yourself. Yeah, you got
TLDR, man. TLDR. I can't do that. Can't read. It's too long. It's a good game to watch.
Good show.
It is a good show, but we all have choices. We can all watch that and do our own research. I guess my suggestion is, as some of these things come out, and I think people know what I'm referencing here, and it's not secret, whether it has to do with reporting on what's going on with the Supreme Court, reporting on what's going on with NFL football players, that some things are not true, that people pretended to be true. and presented to us. And so we don't get to act surprised that the media would, I'm going to make Joe Rogan's argument, purposely mislead people. And I've got a real problem with that. And so to use magazine covers or sensational headlines or sensational news pieces, and I'm not saying it's all of media. So I'm using a blanket, but they're definitely.
I think we're pretty close to being able to use blanket statements when it comes to journalism.
Right. And
I think we are getting dangerously close, which is unfortunate, right? Because you'd like to be able to say, well, these guys don't seem to be dramatic, or they seem to tell it like it is. And I don't know.
It's just, my point in this is just danger. Like whenever you are consuming prepackaged or presented information through the media, take it with a grain of salt, do your own research. Like Ian said, open up a tab, start researching. And it's hard because not everything on the internet's true either. I'm not saying that, but use discernment, read up, use price charts rather than CNBC headlines. That would be, I guess, where I would start. And so I don't even know how I got here, but we should probably get back to a little bit talking about one of your favorite sub industries, gold miners.
Ooh, what a tumultuous relationship. It's like that first relationship you had in high school where, it's very back and forth. Sometimes you're happy, sometimes you're arguing over texts. That's how my experience with gold miners has been. Sometimes I gotta get upset over a text message.
This dates me, but none of my high school arguments happened over text because we had QWERTY.
Oh, mine did.
So that's too much work, man. Like to have an argument with QWERTY. You kidding? Oh man, not happening. But I get why text would be the way to do that, and that still happens today. I see it happen all the time.
Yeah, you got kids.
Oh yeah. Oh, do I?
Yeah. So it is. It's a long time running joke on our team. Inside joke, gold miners and Ian's
love-hate. It's a love-hate relationship.
Love-hate relationship. But I'm back to loving them for the time being. We'll see how they act, when we go out this weekend. But
I think using something like GDX for gold miners, if you're pulling up a chart being above $31, you're absolutely right. You can love that. That's something you can appreciate and support. Junior gold miners, they seem to be holding a rate of trend that goes all the way back to 2015, reclaimed important levels. We'll see where this all goes. What about the underlying metal? So we're talking miners, but what about gold itself?
Gold itself having a rough day today, and so now we're just still wrapping around those highs from 2011. 1800 is
so there's
the line.
Two really important things you said there. So you're using gold futures, yes. I assume. So this consolidation, if we want to call it that, or this correction through price and time since August of 2020 is wrapping around the highs that go all the way back to 2011. So we have that in play. But then also from the near term perspective, you brought up a really interesting juxtaposition that also ties into how we're seeing commodity strength with the dollar. Is it significant that we're seeing gold miners hold up today while gold is down?
I think so.
Yeah, I think that's something worth paying attention to. If gold mining stocks are going to be up while gold itself is down, 1.5-2%, probably worth paying attention to that. Maybe your relationship has a little more legs to it.
Yeah, maybe it'll make it a couple months this time till we break up.
Yeah, till we break up. We'll see. But it is, from a big picture perspective, if we clear this series of lower highs that go back to August of 2020 and move higher back above 1800, it could be seriously game on for gold. We'll see. Time will tell. We talked a lot about domestic US based equities. How about internationally? Because I think there's some interesting developments there.
It has its pockets. You had now, not a great
relative. What do you mean by that? By pockets?
Lots of areas moving higher. Like, all right, take Canada for example.
Okay.
New highs, relative chart not that great. That's cool. At least it's participating. We know that Canada is big materials, big energy.
But a beautiful retest of the break using something like EWC representing Canada and breaking above 35.40, which was the highs all the way back in 2008, and consolidating above that, now making new highs. Like you said, participating. Canada looks really good on an absolute basis, because that's a massive base on that thing. What else? What other pockets? What other areas that are interesting?
Well, you've got Indian small caps that we've covered a lot on here. Saudi Arabia, obviously Russia, right? These are all kind of probably tied to the rally we've seen in crude. But you've also got Poland, Indonesia, Colombia perking up on a relative basis.
Yeah.
Australia. So, there are areas now. As a whole, China still a headwind.
Yeah.
Kind of tries to get going and then, falls back down. But there are, individual areas out there. And they seems to be the ones tied more to. I think we could see some strength out of Latin America here soon.
Mm-hmm.
Maybe, right? That's more of a materials and mining area. You just see good strength, but
it's dealing with that truly does have, even in some ways, I feel like a higher headwind or a bigger headwind when the dollar is strong.
For the dollar, yeah, we're going to need to see the dollar really come into a true downtrend,
and we've got
that to pick up.
I think it's interesting that, and I'm going to try to communicate this well. So you look up a relative chart, Ian, of emerging markets versus S&P on a weekly time frame. We've been making new all-time relative lows since July, and we seem to be creating this pennant, which is a compression in price in that relationship. So that, like you said, the biggest component is China in there. So that pennant, I think, is going to give us some tremendous information. Then I pull up a chart of FXI by itself on a weekly, and we held $38 real nice and had bullish engulfing last week. That seems to be getting followed through this week. So while we're seeing weakness, from a relative standpoint in emerging markets, I don't know that you can necessarily be short China, because you've got this scenario where demand showed up where, quote unquote, it should have.
If BABA was below 135, 140. Anyways, if BABA breaks its recent lows, yes, we can start talking about, and maybe that's right. Maybe that's what this bounce has been. Maybe the weakness in China isn't over.
Yeah, who knows? All I know is that last week was a good start for China. We're following it through to this week, and emerging markets on an absolute basis appears to be holding a real nice level. It's wrapped around the highs that go back to 2007. We do have a bullish RSI divergence from the August 21 lows and the most recent ones here beginning October. Are we moving higher in emerging markets from here? I think something could be said for that. And I think the dollar will obviously play a role, because some of emerging markets is Latin America. And so, a weaker dollar is going to help that for sure. But if you can't get too tied up in that, just like we talked about before, because you could have the dollar hold up and all these material and mining and everything, and energy, that's right up the alley of Latin American stocks. And you could see those rise. So we could see emerging markets outperform from here day by day. We'll see. But your statement is not blanket international stocks as a whole doing well.
No, definitely not as a whole. we're not running towards Europe. I mean, if you take Europe as a whole, still pretty abysmal. In fact, using like VGK, you're close to all-time relative lows.
Yes, correct. All the way going back to October, November of last year, on the verge there. So we'll see. We'll see if they can change that. And so we're open to that on a week by week basis. So there's definitely, you named a lot of countries that, like you said, have exposure to materials, have exposure to energy, both areas that we've seen do well and have relative strength. We'll see if any of this pans out broadly, but not yet. There's just certain areas that are doing well. You just not blanketly buying all international stocks, which can change. We can look back 6 months from now, and I'm sure we'll notice it before then that we would start to see demand for that. The other thing to talk about is in the credit markets. So in the bond markets, we talk rates, we talk treasuries, but we're also seeing junk bonds and high yield come back here a little bit. And that's not risk off.
No, not at all. You take junk yields or junk bonds versus their, we'll call it treasury counterpart.
Like IEV.
I'm sorry?
Like an IEV, something like that. Like JNK versus IEV.
Or IEF.
Or IEF. Okay. Sorry, IEV is Europe. We're not doing that. We're doing junk versus IEF. Yeah. Trying to break these levels that go back. Now, there's been a lot of resistance, and surprise, this chart also has important price history that goes back to the beginning of the year that also supported what we've been seeing with the stealth correction over the past 8 to 9 months. But with junk bonds improving, that's risk on behavior that we like that. So we've highlighted lots of different risk on behaviors. And I know you were on Fox this week talking about, the potential of small caps breaking higher, and the evidence continues to build for that. I don't think we're at least the last few days have not provided anything contrary to that.
No, have not at all. You've seen small cap growth and small cap value work, right? So we've seen a lot of these software names come back.
Software.
So there seems to be good breadth there, and it's not just E&P names and regional banks.
Yep.
Healthcare still, I think healthcare still remains in the avoid bucket.
Yeah, healthcare is a mess.
Staples, Staples might go out at new all-time relative lows today. Utilities back pretty close. Comm services just abysmal, but everything else pretty healthy overall.
Yeah, I think that you brought up some really important points there, in that not all of the sectors are out of the woods. Healthcare is not the same as what we're seeing out of energy. We're seeing semiconductors potentially rebound. Consumer discretionary, when you look at the consumer staples versus the consumer discretionary chart, using XLP versus XLY, today breaking down to new relative lows. That's might be the chart of the week, actually. That is risk on. When we're seeing that relationship break in the favor of discretionary, I don't know, that screams risk on. And so we'll see. We're not out of the woods yet. To your point, we like to see some levels clear out. But when you see discretionary and potentially software, an old leader, come back into play, it could be game on here in fourth quarter, and we could be ripping higher and surprising a lot of people. We'll see.
What if we get a VIX below 15, 14?
There's a name I haven't heard in the past few podcasts.
Now it's fine. For the umpteenth time in the last 6 months, it is again finding support at 15 today, or in that area, 15, 16. But you get below that, and we probably have a nice Q4.
Yeah. And Ian's point is simply lower volatility tends to be a characteristic that you see in uptrends, and nice grinding uptrends, not just crazy chop. And so if we're below, you're right, because this level here on VIX around 15, and let's call it, between 14 and 15. If we're below that, because that's had historical significance going back again to the beginning of the year since we've seen the stealth correction taking place, that would make a lot of sense to see that instrument break below there as equities are making new highs. Great point on that. The VIX. What a party that will be. We'll see. Anything else, Ian, before we wrap up the extended portion and call it a pod?
No, not much to add. I'd say we're probably a little bit more bullish than your average, investors out there. There's a lot of people think this correction has more to go. As long as Russell is in this top half of its range, it's kind of hard to go through the bottom of your range if you can't go through 222. Hard to get through 209 if you can't get through 222. So
exactly. It's math. And I should add, congratulations to your Atlanta Braves. I don't want to talk about it too much because I'll get emotional. I get very sad that my Brewers got eliminated.
It's a good series. It's a good series.
Well, it's a good series.
No
Atlanta
game
won.
5 shenanigans like we had in the
the other
Dodgers
side.
Giants series.
Yeah, that's unfortunate. It's going to be interesting to see the Braves play the Dodgers yet again.
Especially after being up 3-1 last year.
I'd love to know how many innings Charlie Morton's going to pitch because the guy's been lights out, but yet you can't bury his career. So it's going to be, it's going to be a good series. And so I know you're bullish on Atlanta too. Excited to see these games play out. I've been slowly getting myself back into watching some of them.
Your Vikings are in town in Charlotte this week.
Yeah, man. Make sure to holler at them. Tell them to start converting some third downs, and on the opposite side, stop giving up third downs. I'd appreciate it.
All righty.
All right, man.
Sure to do that.
I know you will. I appreciate it. All right, man. Appreciate your time and insights, and we'll see you in here in a few days. It'll be a good time. All those listening, thanks again. Have a great week ahead.
Have a great weekend.